Okay, here's a question for you. Would you rather make 20% returns with hard stopping losses along the way, or make 15% with a smooth ride and minimal stress? If you are thinking long term, then you need a metric that measures both return and risk, and that's where the Calmar ratio comes in. In this video, I'm going to show you what the Calmar ratio is, walk you through how to calculate it, and help you use it to spot smart, sustainable investment strategies. Let's break it down after the intro. The Calmar ratio is a risk-adjusted performance metric that tells you how much return you're getting for every unit of drawdown you're risking. So, in other words, if your portfolio makes great returns but crashes hard during downturns, Calmar will call that out. Now, unlike the Sharpe ratio or other information ratios, which uses volatility, Calmar uses something that's much more scary: maximum drawdown, your biggest portfolio loss from peak to bottom. And that's why long-term investors love this ratio. It's all about balancing reward with downside pain. The Calmar ratio was developed by Terry Young in 1991. He ran a California-based hedge fund marketing firm called Calmar, which stands for California Managed Account Reports. And that's interesting to know, right? He wanted a simple, intuitive way to compare hedge funds and money managers, not just based on return, but on how much risk they had to make to get those returns. Especially risk in terms of big, scary drawdowns, not just day-to-day wiggles. The Calmar ratio is beautifully simple. It's the CAGR divided by the maximum drawdown. Let's break that down. The CAGR is the compound annual growth rate, your average yearly return accounting for compounding. And the maximum drawdown is the largest percentage drop in your portfolio from peak to trough. It's usually calculated over the past 3 years, but of course you can adapt it based on your time frame. The higher the Calmar ratio, the better, because it means that you are earning strong returns with less painful drops. Let's bring back Bob and Alice again. Bob has a portfolio that returned a CAGR that's 20% over the last 3 years. But at one point he suffered a maximum drawdown of 40%. Let's calculate the Calmar ratio. 20 divided by 40 is 0.5. This is a lot of downside for that return. Now let's check Alice's portfolio. She has a CAGR of 15% and a maximum drawdown of 10%. And the Calmar ratio is 15 divided by 10 is 1.5. So you see here, Alice has a lower return but a way better Calmar ratio. It means that she earned those returns with much less risk. Her strategy is more stable and likely more sustainable long term. Now you might ask, what is a good Calmar ratio? Well, here's a quick cheat sheet. A Calmar below 1 has too high risks, and those risks outweigh their returns, which is not great. A Calmar between 1 and 2 is acceptable, but keep an eye on drawdowns. Between 2 and 3 has very good risk-adjusted returns, and a Calmar above 3 is excellent, low risk and high returns. And this is why Calmar is so powerful. It penalizes huge drawdowns and rewards smoother strategies. Now you can use Calmar ratio when you want to compare funds, ETFs or strategies over a few years, or if you care about survivability, not just returns, or if you're trying to avoid painful drawdowns. It is a ratio that is common in hedge fund reporting and professional fund comparisons, especially in volatile markets like crypto or high beta sectors. So let's do a recap. The Calmar ratio is the CAGR divided by the maximum drawdown. It shows you how well your strategy handles real-world crashes, and it's perfect for long-term investors who care about risk control. Now, if you have learned something new, then tap the like button, drop a comment with your latest drawdown or what Calmar ratio your portfolio has, and don't forget to subscribe, because this is part of a full performance metric series. Become a patron if you want to support me and motivate me to make more videos in the future. I have also written a book that contains more information about algorithmic trading, and it contains a whole chapter on how to analyze your results and determine the best trading strategy for you. Now, if you want to know more about other investment ratios and how to use them, then check my playlist and watch out for future videos in this series. Thanks for watching, and I'll see you in the next video. Goodbye!